Just checking. Yeah, okay. Hey guys, welcome to Best Bitcoin Data Show. We have our second episode here with PlanC and Sminston with. And today we're going to talk about quantile regressions and a whole lot more. So if you watched our first episode, this is a show that's going to go on periodically. And we will handpick the best Bitcoin data that we can find, and we are putting our brains together with a group to figure out what are the best and most actionable and most interesting data points in this Bitcoin space. And some of it is the interesting things we find elsewhere, and some of it is actually developed by ourselves. So today, actually, we are talking about a few of the models that are developed by ourselves, and PlanC and Sminston with they will actually showcase their own work, which is very, very interesting. The theme for today, as I said, is quantile regression. So I'll let the two gentlemen introduce themselves very briefly. Then I'll just set it up. I'll explain a little bit about quantile regression, why it matters, why it's interesting, and then I'll let PlanC explain his work on this topic, and then followed by Sminston's charts and data. Okay, how do you guys feel about it?
Yeah, welcome back, everyone. Episode 2 here. Excited to share some more good data. So last week we did like a bit of a introduction and kind of explain what the show is going to be about. But yeah, we're essentially looking to handpick, the best data available and just share it every week. And over time, the show will evolve. We're going to share, like you said, some of our own charts, and then we'll just kind of also, as all of us are constantly researching, we're going to find the best charts available to share. So, if we want to get into, do you want me to explain very briefly my background, or just?
Just a short introduction, and then Sminston. Then we will actually begin the content.
Okay. Yeah. So I've been in the space since 2017. Very passionate Bitcoin researcher. Spent multiple years, looking into all the on-chain data. And more recently, over the last few months, I've been extremely obsessed, and obsessed is the right word, with the power law, and looking at all sorts of derivatives of the power law. So, Sina, you had a great post just yesterday. For anyone who hasn't seen it, Sina did a really good post, kind of showing the robustness of the power law. Going back and kind of, you can explain better what you did, but essentially taking different time frames and kind of seeing how the power law would have held. And it's extremely robust, right? It's been extremely accurate. The last 8 years, it's held up very well. We've looked at this in various ways with R squared. R squared, for those that don't understand, it's kind of like explaining how well a model follows. Essentially, the data points followed the model. And so, there's we've looked at R squared. We've looked at many aspects of the power law, but it's very robust. So it's a great foundation. That's kind of the conclusion I've come to. Is it's a great foundation, and then from that, to get more precise, what we're essentially trying to do here, and the process, you guys are going to follow us along on this journey, is we're looking to take the power law as a solid foundation. That's in my opinion, the best available foundation to build upon. And then we're essentially looking to do these derivative models and things. So that's essentially what we're doing with the quantile regressions. That's what Svensson's going to share with his Decay channel. So these are various ways of lenses of looking at the power law through. So the last few months, yes, that's been my main obsession, is the power law. But I'm still very passionate about on-chain data. Still very passionate about TA, and all the other lenses we'll also incorporate as we go along. So that's basically a summary.
Awesome. Just I'm also sharing the post you talked about that shows power law model. If you ran a power law model in 2016, 17, 18, 19, the accuracy of the model today would actually be very, very high. And 8 years ago, the model that's built 8 years ago would still predict accurately what's happening today. So on this chart, you can see the blue one and the dotted ones dotted line is today's model using all the data. Blue one is a model that you would have created in 2017. Yellow is one in 2016. and then green and gray are 18 and 19. You see, all are close. And importantly, this is 8 years after let's say the first model. 8 years after the 2016 model, it still works. So that tells me that it's capturing some real dynamics in the data and real forces. It's not overfitting the noise. We have 540 people watching too. This is amazing, guys. Thanks for tuning in. And then a quick intro from Sminston.
Thanks for the intro from PlanC, and Sina, thanks for getting this going. I'm happy to be here for episode 2 with the crew here. We've got the full crew, the full trio. I just want to say I met PlanC a matter of months ago. I am coming up on my complete first cycler. So I came to the Bitcoin fray. I learned about it in 2020, but really didn't start becoming involved from a research standpoint until sometime over the past year, and took it a little more seriously starting, a few months ago, really. Made these connections with y'all, and my background is chemistry, material science, and I've actually been an engineer and a researcher in energy storage and batteries for almost the past 10 years after completing my PhD. So this has been the most significant technical passion outside of what I normally do for my job. And I never thought of myself as getting into the financial world, but this is, I'm sure there's some common threads here as far as what attracts us to Bitcoin as an asset, but the inherent reliability of it gives us so many options to evolve this into second order and third order sort of analyses. So this is where I really like to sink my teeth into. Most of what I've been doing lately is price analysis, historical price analysis, power law especially, but I do have broader interests outside of that as well. So excited to be here.
Very
Thanks,
good.
Sina.
Awesome. So what I'm going to do is I'll quickly set us up, explaining a little bit about the quantile regression, which is an advancement in modeling Bitcoin. We have the base power law, which is an OLS regression model. It basically captures the average expected price for Bitcoin over time. But now we have discovered that quantile regression fits the data even better. And perhaps that's not the best way to explain it. Essentially, it's a richer model to fit the data. That's how I want to characterize it. And then I'll hand it over to PlanC to actually show his work and move on from there. Okay, so, So you should now be able to see my chart. I will quickly mention that most regression models that people run on Bitcoin data are typically OLS models. OLS is really good, efficient. It does a great job creating a line that goes directly through your data. And if you've done your job right, you can capture some interesting trends in your data. But the challenge that it has is it assumes something that in technical terms they call it homoscedasticity, which means the distribution of the variable you're trying to model doesn't change over time. Okay, but is that true for Bitcoin? In this chart, what I'm trying to show is that this is a chart of just one metric that I've randomly pulled, the MVRV over time. And you can all see that MVRV in the first cycle goes all the way up to 8, close to 8. Second cycle only can get up to 6. Third cycle only 5. Next 4, next 3. And it probably is going to go down. So what is this telling us? This tells us the volatility of Bitcoin is going down. This tells us the variance. Everything that I said OLS assumes is now becomes wrong because the market structure changes. Every cycle is different. And that's what has tripped up many analysts and using the models that have restrictive assumptions. So if the Bitcoin's distribution changes, and we can actually confirm that here as well. In this chart, I'm looking at just the volatility of Bitcoin, essentially the change in percentage change in price over time. Now, you can clearly see here that volatility has been going down. A lot of people have opinions about volatility is not going down, but data doesn't agree with that. So volatility is going down, and that also means the variance is going down. The distribution is changing. So OLS is not it's pretty good, but not the best model you can use. So today we're gonna use quantile regression, which just to introduce it a little bit, if you run a basic OLS regression model, you are trying to find a line that goes through the middle of the data and try to find the average. But you can think in terms of quantiles. So 75th percentile, as you see here, or 25th percentile, or even you can go to the extremes, look at 99th or 1 percentile, all those, and median. And actually, these things are a little bit more resilient to outliers, because outliers don't really change quantiles at all. And as I said, in an OLS model, you're assuming that there is always a distribution of values around the average line, but that distribution is assumed to be stable, which is not the case in Bitcoin, as I explained. So quantile regression, essentially, if you look at these green and red, what it tries to do, it gives more weight. It gives more weight to some of the quantiles. And what PlanC is going to show is that we're trying to capture the highest quantile and then the lowest quantile to give us a beautiful channel of price growth. So what it does, it just gives more weight to those points, but also still including all the points. So it's not like somebody is just connecting the top dots or bottom dots. It's actually using all the data, but it tries to model more accurately what's happening at the edges of the channel. Okay, so with that basics, I want to hand it over to PlanC to share his work. So if you want to, you should be able to click present and share your screen.
Oh, okay. The chart is it's in the Telegram group. Do you mind pulling it up? Just the last one. It's also the one I posted most recently on X. Sorry, if I do it on my end, I think it'll be more clunky, but I can start talking about it as you're finding the chart. So yeah, I mean, Asina explained extremely well. He has a very strong background in data analysis academically. And so, yeah, essentially, and correct me if I'm wrong, either of you guys, with anything I'm saying here, because I care more just about getting the information across correctly. But my understanding with quantile regressions is essentially looking at like a cumulative distribution of probabilities, right? I believe that's one way to describe it. And so, yeah, the goal is to kind of, for me, is to create a channel that can best, because a lot of people will give like a single target. Okay, I have a model like this. This is the kind of clickbait stuff you're going to see on X. Is like, okay, I got a model, and my model says we're going to this price. Well, nothing, like, it's all based on probabilities, right? And so the way the reason why I like quantile regressions is because we're essentially looking at a cumulative distribution of probabilities. And so all we can say is essentially, look, last cycle we got to this quantile, the cycle before we got to this quantile, the cycle before we got to this quantile. If we get to this quantile again, this will be the price if we get there at this time. So this is a zoomed out chart, and this is the 99.9 quantile, right? And so this is the absolute extreme of the tops and bottoms, right? So this is not saying we're going to get to 343,000. That's not what this chart is saying. It's saying if we got to the most extreme quantile, right, the absolute highest deviation, you could say, or not deviation, the most extreme of the data set, right? The cumulative distribution of probabilities. If we got to the absolute most extreme and we reach there at the very end of next year, the price would be 343,000, right? And so it depends when we reach, right? If we reach mid next year, that would be a different number. So this is the zoomed out version. What I'm working on right now is a way more detailed version. I didn't have it ready for today, but I'm going to have it ready in the next day or two. It's a zoomed in version that is breaking down by the quarters. So starting in Q1 of next year, I'm doing Q1, Q2, Q3, Q4 of next year, and I'm actually including 2026 Q1 and then 2026 Q2, because who knows? Maybe the cycle extends another half year. We don't know, right? And then I'm going to break down the different quantiles. So if we reach the 99.9th quantile, these will be the prices depending on which quarter we reach. And then I'm going to do also the 99th quantile, and then probably as down as low as maybe even 80 and 90 quantile, because we don't know. Maybe we don't get all the way up again. But we did reach the 99.9 in 2017 peak, and we did reach the 99.9 in the.
So take a step back. Explain what we're looking at. So what's the red line? What's the blue line? And what are the numbers?
Yeah, so the 90. So when I say 99.9 quantile, what I'm referring to is only 0.1% of all the data points. So this is hourly data for the entire history of Bitcoin. So this is the full data set back to the very beginning since we had access to any data, which is July 17th, 2010, right? So full data set, hourly data, 120,000 120,000 data points. So out of all those data points, the red line is based on only 10% of the data points, or sorry, not 10%, 0.1% of the data points are above that line, right? So that's 1 in every 1,000 data points falls above that line. So it's the very extreme outliers to the upside, right? During the bull run, these are the by definition, when you're in that extreme, you can essentially assess like, okay, when you get to that red line, like we're really in overheated territory because we've only ever been had been this high 0.1% of the data points, and it's the same on the other side, right? We're looking at, I believe in this case, it's actually 1% of the data points fall below the blue line. The version I'm creating it's going to be 0.1%, but this is only 0.1% of the time are there any data points below that blue line, and then 0.1% above, right? So only 1 in every 100 data points falls below the blue, and only 1 in every 1,000 data points falls above the red. So when you get close to those lines, you can essentially say, wow, like based on the full distribution of probabilities, we've only ever been here such a very small amount of time. This should be an indication that this is an extreme event, right? So that's how I look at it. But for example, in the last cycle, we got up to, I believe it was, it looks like we didn't get quite as high. We actually got up to the 99.5th quantile, I believe, of the last cycle. So we actually got quite high, even though on the chart there's a little bit of a gap there. We actually got up to 99.5 quantile, I believe. I'll double check that. We definitely got over 99. So in the previous two cycles, the 2013 cycle, we got to 99.9 quantile, 2017 99.9, and I believe last cycle it was either 99 or 99.5. So we can essentially we can look at that and say, okay, based on which quarter we reach the peak, right? Each quarter I'm going to give a range. So I'm calling this the power law probability channel, is what I'm ultimately going to call it. I think it's just a simple, instead of using the quantile jargon, regression jargon, power law probability channel. I'm going to do a zoomed in version showing each quarter, a range of prices depending on what quantile we reach, and essentially probably starting at 80 all the way to 99.9. So that's what's coming. But that's the kind of stuff we're looking to create here, is not necessarily tell you guys this is exactly what we think we're going to get to for the price, but more, this is the data. You guys decide what you think we're going to get to, right? And we can discuss our opinions. Of course, we're going to share our opinions, but we want to present the most honest data to you. And also, there are some. I'll wrap it up here, but there are some potential things with the quantile regression that we're still ironing out. So I was talking to PlanG, or Giovanni, who's creator, first person discovered the power law. You guys some of you guys probably know him. We were discussing the idea of using a 4-year window for the quantile regression, essentially a rolling 4-year window, and we can get into that another time. So, anyways, I'll let Svensson go. But and Svensson and me have had some great discussions recently about essentially some potential concerns about the quantile channel. From a decay standpoint, he's run some really good analysis that he posted yesterday that I'll let him talk about, that I think is very valuable. So it's an ongoing thing, right? We're going to change things as we go. We're going to update and just give you guys the information. So I'll let him go.
All right. So
awesome.
Just give me 1 second. I'm trying to.
Nice work, PlanC. That's a great channel. Yeah, go ahead. Sorry, Sina.
Okay. So how do we How do we share your content?
Oh, you know what? Check your XDMs or just the Telegram. Either one. Right. and I'll feed you a couple more, I think, as we go.
All right. So if you want to set it up and explain what's coming.
Sure. So it's really, I mean, we could spend probably a whole episode or more on like the nature of the quantile regression. I think Sina gave a good, succinct sort of summary at the front end. What I love about the quantile regression based channel that PlanC put together, and it's not his first one, by the way. I think this is the latest evolution in a series of them, which I really inspired a lot of my work, I think, for the last few months, especially on the support line underneath. What I will say is that I think what's great about the red line on the chart that was just being shown from PlanC, I think ultimately it's going to be a really useful absolute upper, what the upper bound of what is even remotely possible. And if I don't want to speak for PlanC, but I think that that's what he's really trying to establish there. I think that, and yeah, PlanC looks like you want to say something.
I was just going to say that's exactly it. I think that's
Okay,
a good way to look at it. It is like the absolute upper bounds of the probabilities.
Yep. Yeah. I'm with you. And I think what I'm going to show here, I think for the sort of the setup, and see how much time I have to get into this analysis, but it's essentially showing the historical trend of what a future date's, 99th percentile, very at the very top, what that price prediction would be for a specific, there we go, what that would be if you had performed that quantile regression starting way back in 2013 all the way up to today. And what's cool about this is you see the evolution and you actually see a trend. You see the trend initially being a very, very high prediction, and then it actually slopes down in a sort of quasi, I believe it might be an exponential decay trend. So this is going to be some of my future work. But what Sina's showing here is my post from yesterday. So of course, and it's sorry, it's a little hard to see. Thanks for zooming. I'm showing the 99th percentile power law quantile regression fit for the top chart. That's a mouthful. So not quite the 99.9%, but I'll get to that. So I wanted to start with 99th percentile just because you have a lot more data points to play around with to actually do the fitting. So this is simulating if you were to go back in time to July 2013, so kind of before that second run up, right? And started to do this every week, every 7 days between that point up to today or yesterday. And what it's trying to do is it's projecting all of those models. So all those pink and orange and yellow models are capturing that 99th percentile of the data all the way through the data, okay, in log space. And that dashed vertical line is November 1st, 2025, which is, roundabouts where I think some people are, if you talk to PlanG or PlanC or some other analysts, I think we're anticipating a peak in the ballpark of that, give or take. And so I kind of semi-arbitrarily took November 1st, and I wanted to see what would it predict just at the 99th percentile. If we do peak there and we get into the 99th percentile, what would it predict that price to be? And then, so that's the top plot there. And I don't have the animation skills, quite the same animation skills as APS-K32, but I'm working on it. But the bottom plot is basically taking a cross section of that dashed vertical white line from the top one and plotting them from plotting them in terms of the cutoff date. So July 2013 is on the far left where it's bright pink. And then as you're modeling closer and closer and closer to the present date, that predicted value of November 1st, 2025 comes down in this sort of sloped decaying fashion.
So all of this chart is predictions for November 2025, but
That's right.
You're making predictions only using older data point here. Now, when we get to the yellow, you're using all the data points up to today to estimate that November 2025.
Yeah, it's kind of like the evolution.
Exactly.
It's the evolution of the prediction based on how much data you're using over time. So like it's kind of showing the evolution of the prediction to see if, I'll let you keep going.
That's perfect. So the kind of a couple takeaways from this is that there's an interesting trend here, right? In terms of that evolution that PlanC just mentioned. It's not like a stochastic jumping around of the model. There is some of that early on, but it starts to fall into this decaying trend. And the advantage of that is like the question becomes like, can we use this then to sort of like project forward like a few more months or even a year or further out to see where this trend is going to land for different percentiles. Make the assumption that the peak is going to happen on November 1st, 2025, or even a year later, whatever. Pick a date that you think that's going to happen. And then where does this converge at? Where does it sort of like stabilize at? Because that's what it's happening here. It looks like it's stabilizing. So I think that's the interesting takeaway. PlanC mentioned that I was having some skepticism about kind of the quantile regression approach. Kind of my biggest beef with it quantitatively is that it seems to historically kind of like over predict those different the last couple of peaks, the last couple of cycle peaks by a decent amount. PlanC mentioned I think 99.5th percentile versus 99.9 percentile. That seems pretty close, but that's actually a pretty big price difference.
It's a big price difference because if you're using 99.9 versus 99.5, I think it's like $100,000 difference.
That's right. So it ends up being like substantial on a dollar value terms. So, but this might be a way, and essentially to give some more confidence and maybe improve the quantile regression model for the tops. And PlanC and I have already talked a bit about this. We might be able to enhance a corrected way to project for certain dates in the future by following these trends. Is kind of the idea.
Yeah. Can I just say, like, I think this
go ahead.
First of all, I think this is awesome work because this is how you validate. And Sina is also, strong. Both you guys have strong data backgrounds with your profession. So, this is great because I have all these ideas and things I want to do with analysis. But it's really great to have you guys on board. And I'm learning these concepts as well. I don't have the academic background you guys have, but I have the passion and I'm constantly learning. So between the three of us, like we're looking to not only handpick the models, but we're looking to validate them as best we can in various ways. And so that way we can be confident, just to present the most accurate data we can. And so this is a great example of that, where you've actually gone and shown, okay, so we have a model, like we like conceptually, quantile regressions is a robust model. It has a lot of value. You're using all the data points. You're looking at the probabilities of the different quantiles and estimating, okay, where do you think we'll get to? But this is showing how it's stabilizing over time, which I think is very useful because it's showing that this would not have been a good model to use 5 years ago. It wouldn't have worked. It wouldn't have been effective. But it's becoming a better model over time. It's actually what's happening is we're seeing some stabilization in the predictions, and it's becoming more useful. So the trend of this based on what you're showing here, the trend is this is becoming a more useful model potentially to use over time and into the future, but we have to assess how stable it is. It's similar to the power law. The power law has been stable now for 8 years, but we've run analysis on the stability of the power law slope, because if the power law slope was still not stable, then the power law would be less useful at predicting future prices. You could maybe use it to predict like shorter term, but you couldn't extrapolate out 5-10 years with the power law. But because the power law slope, and when I say slope, I mean the growth rate of the power law, because that slope has now been stable for pretty much 8 years, we can extrapolate out 10 years with the power law. So it's the same thing with this, with the quantile regressions. We're kind of trying to assess how valuable is this to extrapolate out, and how far can we extrapolate out, and do we need to do some sort of an adjustment based on the slope there. You can see how it's kind of over time, that slope. Do we need to kind of quantify that slope and that pattern and incorporate that in to actually adjust potentially the top quantiles to get a more accurate prediction? So there's ways to potentially improve this, right? And so it's a work in progress, but we're just kind of showing you guys along the journey. And these are the steps we're taking. So I'll let you keep going, though, if you have anything else to share. But I think that was great. You explained.
Yeah.
That.
No, thanks, PlanC. I couldn't agree more with everything you said there. So this began as exploratory, and of course, I want to chase this further down the rabbit hole. I did share. If you could show one more quick chart on that. I don't know if you can look at your Twitter DMs, if that's easy to do, Sina.
Is it this one, or it's a different one? A different
one.
It
is.
So let me see.
They're kind of it's Viridis color map, so it's yellow, purple, yellows, and purples.
Come on, man! You're sending me on Telegram, or
no,
Twitter.
But I'll send it to you on Telegram. That'll be easier. Here, I just sent it on Telegram.
All right. Okay, so
Yeah.
So basically, there's one, while you're pulling that up, there's one more key takeaway from that, which is that given my original, there need to be some improvements or additions, I think, layered onto the quantile regression approach to make it a little bit more predictable to catch those peaks. There we go. But what I also like about this is that it actually gives me more confidence that there's a basis in the quantile regression method that might push us higher, because the models that I've been putting a little bit more weight on are frankly some of Plan G's work from the past, Giovanni's work building onto his power law model with the oscillations. There's the 4-point decay channel oscillator that I have that points to a range of like 200 to 240,000 if the peak happens in 2025. From what I'm seeing with these trends, if we can, it gives me a little more confidence that there might be some room for possibility of higher than 250K, perhaps. I don't want to hang my hat on it yet, but it's basically prices closer to 300K might be more realistic than we think, is what I'm getting at. That's one of the takeaways. More to be seen here. So this is just plotting all of the percentiles, or sorry, the 80th, 90th, 95th, 98th, 99th, and then 99.8, 90, or 99.5, 99.8, and then 99.9 percentile. So the highest, the yellow line on here is the same percentile that Plan C is using for his red upper bound in his channel. And if you do, I shared with you a zoomed in one, so it's a little more clear. But each of these have a slightly different trend, and the data gets a little bit messy, which I can explain why that is. But what you generally see here is an evolution of decay patterns across the different percentile spectrum. So as you get further away from the support line and closer to the very, very tippy tops, of the bubble data, for example, you have a lot less data to work with there, but there still tend to be these decay trends, and they happen at different rates. So so that yellow one is 99.9th percentile. Yeah. And they all start very high and they decay lower. If I sent you one more image, if you want to jump to it really quick, and you can kind of see where they land. And then we can probably move on from this. That was kind of the zoomed out view.
Just takes a few seconds.
Yeah, no worries. Sorry, I should have had these loaded for you well in advance.
Yeah, no worries at all, guys. Like this is the first time we're streaming live. We're actually streaming live on all three of our channels. So some of you guys are watching on each of our individual channels, which is pretty cool. And this is also live on YouTube as well on Sina's YouTube channel, which is a great YouTube channel. If you guys haven't checked it out, you should definitely subscribe to that. Sina, what's your YouTube channel for those that are watching on X?
21st Capital. Just look for 21st Capital. Yeah.
21st Capital.
We have
so this is just the very
almost 1,700 people watching.
Amazing. Lots of viewers. Amazing. Thanks everybody for watching. Yeah, this is just a quick, very briefly, just zoomed in. You can see how everything starts to converge at these different percentiles or quantiles. So yeah, there's a smaller and smaller difference as you get to the tops, but right now it's looking that, so the reason for sort of the low resolution as you get to the higher percentiles is because, as Plan C mentioned, there's just so few relative data points near the top. So as you cover
is still November 2025. Okay.
Still targeting, right, exactly. Yep. Yeah, so it ends up becoming a little lower granularity. So you have like a lot of these linear sort of step looking patterns once you get to the top. A way that you can get around this, which I want to play around with some more, is Plan C. I think you were using like hourly versus daily. So this is what I'm using is all daily at this point. So I actually want to try hourly in 10 minutes to see if this can smooth out a bit more. Yeah.
Yeah, exactly. Like the nice thing is we have access to 10 minutes data and hourly data. So we're going to get this down to like a really refined, point. But we're and the cool thing here though is you're showing, well, what's the range you're showing from the 80th to the 99.9? What's that range roughly? Looks like about 175 to 300 or 325 or what's...
Yeah, it's getting to around 340 340 for the 99.9th. No, sorry, 320, about 320.
And then the low is 175 if we only got to like the 80th percentile. So
that's right. And that's a little lower than what you were showing, but I don't think you were showing November 1st, right? You were showing like...
I was showing the end of the year.
End of the year, exactly.
End of the year. I'm going to show a more zoomed in version based on whichever quarter we peak in or whichever exact, you know.
So it's in line with what you were showing with your chart, which is perfect. So, yep.
Now, something that really stands out to me is, you know, how stable this thing is. Even though we do see the range has changed a little bit, but this is predicting November 2025 in 2021. So 4 years back, you could have had semi-accurate, actually to me, pretty accurate quantile predictions for that match a lot with what the predictions are today. So this, you know, confirming what you said, knowing that there is this decay going on. So if you project into the future, there's a little bit of tendency to overestimate, but at the same time, it's not a huge amount for 4 years of a future prediction. You know, we typically can't even hope to have some predictive accuracy several years into the future. But this definitely tells me that there's something here.
Yeah. So this is pretty much it. You know, I mean, you know, it's still kind of like the jury's still out on where exactly it's going to be, where the cycle peak's going to be date wise, but then what the price is going to be. So I think we're getting closer step by step. So
and I think yeah, well, I was just going to say, I think like what we're looking to do for those, again, that are kind of new to the concept of what we're looking to do every week here, is we're going to bring everyone along on a journey with us where we're literally going to look through, we're going to handpick and assess all these different lenses. So we're going to use you know, power law, definitely these sorts of power law derivatives building on the power law. We're definitely going to use some on-chain metrics. Sina's doing some amazing work with derivatives. So we have some pretty advanced derivatives models we're going to be sharing. He uses machine learning even for some of his models. So it's very advanced stuff. We're also going to use potentially some long-term TA stuff, and then even some sentiment data as well as liquidity. So we're really looking for a holistic multiple lenses. And then we're looking for the confluence, of course, of all these models, right? And over time, we're looking to build out some pretty advanced things, indexes and all sorts of stuff. So yeah, you definitely want to stay tuned. One thing I would say is, you know, where we're at right now is okay. So we have, say, you know, the quantile regression. Sina has a really good volatility adjusted power law he was sharing last week. You know, that's another really good lens to look at the power law through. And then Sminston, you know, you have this decay channel idea. Do we have time today to quickly get into that? I don't know if there's time, but you can give maybe like a really quick update for anyone that hasn't seen your oscillator, because that is using less data points, but it's showing a pretty clear pattern. And it's really interesting. It's going to be really interesting to see if this decay pattern, this kind of like exponential decay pattern continues, because this pattern has been extremely accurate. It's you know, not a lot of data points, but very like as precise as you can be based on how many data points there are. And this oscillator between 0 and 100 has been quite interesting. So I don't know if we have time to get into that today.
I sent you the two charts, Sina. If you want to pull them up really quick, I can be super brief on this. I do think it would be valuable because I think a lot of, at least my followers or people who have seen my charts probably have seen them a lot by now, and maybe could use a very brief, explanation of the oscillator itself. So I don't know if you want to, you can either do the zoomed out or the zoomed in, maybe both.
Okay, I have it up. Just give me 1 second.
Sounds good. Yeah, so I'll just
say one.
So this is based on another channel. So one of the themes here is channels, right? The upper bound of this channel is based on fitting the 4 highest points of the Bitcoin price data in terms of its deviation from the power law support. So that's kind of a mouthful.
What do you mean? Yeah, what do you mean by deviation?
Yeah,
we should try. It's super hard, but we should try to.
I don't have a So
distance or I guess what's the you go
deviation
ahead.
Or distance. So just imagine. So here on this chart, we're kind of hiding. There we go. That's a better view. So 0% here is the lower bound of this channel. So if you imagine, if you're thinking back to PlanC's channel, it's a similar looking channel, but the bottom bound is defined as this 0% value here, and that's
So-
based on the
so
power law.
0% would
That's
be
based on-
equivalent. 0% is equivalent to the blue line on my chart, roughly speaking.
I think you used 1%. I'm still using 5% here, but it's very,
Okay, yeah.
it's exactly same idea. So that's the power law is very well established, and that's what I think most of us analysts in the circle are probably. I think I can speak for all of us at this point. We're most confident in that trend, just mathematically. So all the data that launches above to higher percentiles on this chart are deviations or distance away from that support line towards the top. So the 100% line here is the fit line from 4 data points, and those are the exactly four data points, which is the weakness of this model. But it's the 4 points that have the highest deviation, one for each cycle, right? The one in 2011. 2013, 2017, 2021. There's a single point that deviates the furthest from that power line each cycle. And this fits those as an exponential decay model. And then this linearizes everything and normalizes it so that you can see the fluctuations between those bounds. That's all this is. We could do another session explaining that a little bit better, but this has been like you said, PlanC, it's been a scary precise at hitting those tops exactly near the 100% line. I think the furthest deviation from that is the 2013 one, which is like 95.5%, I think, the one in 2013. And so today we're sitting at the price is roughly 62,000, right? 62,500. And the percentage is like 21.5% in this normalized oscillator. And so if we shot up vertically today, straight to 100%, I think we'd be around 180,000, 185,000. Of course, we're expecting that to happen next year, and the ceiling price at 100% will be much higher. And that's what we're trying to figure out what that's going to be exactly. This model says it's going to be somewhere between 200. If it's November, it'll probably be closer to 240,000. So that's kind of what this model is saying. Yeah.
Yeah,
So-
it'll be interesting to kind of look at the confluence between, as we develop the quantile regression channel, and then also looking at Cena's volatility adjusted model of the power law. It'll be interesting to kind of see the confluence will begin to emerge over time as these models get kind of hashed out. We'll see kind of okay, and then also incorporating, of course, things like liquidity and trying to estimate as best we can the timing of these sorts of things. So.
I do want to quickly say there's strong similarity with the approach in terms of Cena's volatility adjusted power law index, just in the simple fact that it's another approach to take account for this actual exponential decay, this diminishing volatility, diminishing returns, whatever you want to call it. It's a different, it's a less data rich approach to doing that, and just kind of trying to capture the upper bound with 4 data points. But there's a similar thread there, I would say. With Cena's work, which is amazing, by the way.
Awesome, guys, fantastic work. I wish we could go for another hour, but time is limited. So let us wrap it up. So I would basically say that we are fortunate today to have 2 of the researchers, analytic researchers in this space, to showcase their most recent, most advanced models to try to constantly understand how Bitcoin behaves and what are the likely ranges for the price and many other variables. We looked at quantile channel of PlanC that captures the maximum and minimum, roughly speaking, but actually, the highest and lowest percentiles. And these models actually, can be projected into the future to give us a sense of what are the ranges of possibilities into the future. And then Sminston also showed us the sensitivity of that top quantile if you use less and less data, which is a wonderful way to assess robustness of estimation, for example, for this top line. And what he showed us in the bottom chart was that it's actually stabilizing. Like if you use more and more recent data, you appear to be stabilizing with some decay over time. at the same value. So it shows us that this prediction, this red line, has some stability, and it doesn't change as data point changes and more data points come in. It stays the same. And then he also showed us his wonderful oscillator. This is an easy gauge that to give us a 0 to 100 value to explain where we are in the decay channel oscillator. So when we are at 0, it's the bear market bottom. The 100% is the absolute TP top. And right now we are at 22% or so. So pretty much in the cooler side. That's exactly what my own volatility adjusted power law models shows. It's in the cool range. And with all the pump that we've experienced lately, it's wonderful to see the models still demonstrate that the market is cool, and we are way away from the top of the cycle.
Yeah, none of these models, like all three of those models, right? Because we looked at your volatility adjusted last week. We were around 43, I believe, last week or last Friday. But none of these models are showing, these three lenses are showing that we've peaked, right? Some people are concerned there's potential that we've peaked. I mean, that's not what the data is showing. If for some weird reason the peak is in, it would be an anomaly. It would go against everything we've looked at least with these three models. So none of the models are showing the top is in. It's showing a very similar range to where we've been in previous cycles around the same time period. And yeah, we're just going to continue to track everything week to week and continue to bring you the best data we can find, as well as create these models for you. So yeah, anything else you guys want to share? Sina, did you have anything you wanted to get into? I don't know if we have enough time left, but
no, I actually, I'm kind of hitting my time limit.
Yeah, we'll let you go, Sina. Next week we'll make the show a little longer. This week we were kind of just, it's cool to stream on all the different platforms though. So if you guys are, I don't know what platforms you guys are watching this on, but if it's on YouTube, check out all of our X accounts, obviously. And if you're on X, we're streaming on 3 different X accounts here. So whatever X account you're on, check out the other guys as well. And yeah, I'll let you wrap it up, Sina. We can
best Bitcoin data. Best Bitcoin data show. This is awesome.
This is just starting.
Yeah, you guys are wonderful co-hosts, by the way. I think just awesome chemistry. So yeah, shout out to both of you and kicking this off last week. So thank you guys.
Thank you, sir. It's amazing to have you. Last time it was lonely, so we look forward to having you more and more.
And one last thing I'll say, sorry guys to interrupt. One last thing I'll say for anyone watching, we welcome feedback. Since this is a new show, we don't necessarily, we're learning as we go. So we would love feedback. So in the comments and all that stuff, if there's certain things you guys want improved in whatever way you think it would help us out, it's just going to help the show get better over time, right? Because we're really just kind of learning as we go here. So any feedback is more than welcome. That'll help the evolution of the show. And essentially, if we're using too much jargon, too many terms, I know it's really hard for us because this is the language we use when we're talking to each other. So it is like statistics is analysis, and data analysis is a language of its own, kind of like legalese and all these other. So we're doing our best not to use those terms or trying to explain them as we go. And you'll understand these if you don't, these terms, but we do want to bring as many people along. We don't want this to be talking over people's heads. We don't want this to be, a show where we're only talking to the absolute, the 1% nerds of Bitcoin. We want people that are maybe intimidated by some of the charts they see on X or don't know, which charts to follow. We want those people to be able to understand, the data. It doesn't have to be. Our goal is to take complex data, but then distill it down in a way that everyone can digest it and understand it. So give us feedback, and yeah, we'll go from there.
Yes, absolutely. So we are actually looking forward to hearing more from you. Any thoughts you have, any feedback, the more support you give us, it actually gives us more validation that the audience likes this style, and then we will just continue and to do more and more. Again, make sure to follow Sminston's account. Make sure to follow PlanC. Make sure to follow our YouTube channel, 21st Capital, and we'll keep having this show every week and bring to you the best and the most interesting ideas. Like I said, sometimes it's our own analysis and our own models. Other times it's interesting and most important events that happen in the specific charts outside of our work. So our goal is to just fish for the best that's out there and simply explain that to you. With that, I thank you all for listening. We are 4 people away from 2,000 viewers, which is a amazing turnout. Thanks a lot to the beautiful analyses and explanations that both of the wonderful guests gave us. And I look forward to seeing you all next week.
Awesome, guys. Have a good week. We'll see you next week. Take care.
Take care, all. Thanks again. See you next week. Bye.